Consistent profitability doesn't come from chasing high win rates, it comes from controlling risk exposure with precision. A strategy can have a win rate of just 50% and still achieve steady equity growth, if the average loss is kept much smaller than the average gain. This is where concepts like position sizing, controlled drawdowns, and asymmetric risk-to-reward ratios become the real edge. Risk management isn't about avoiding losing trades, it's about structuring each trade so that no single outcome can compromise the entire account. In this video, we're going to talk about risk management, how much to risk on each trade and how to size your positions correctly. Where to place your stop losses with precision. How to make sure your winners are bigger than your losses. Keeping drawdowns small so recovery is fast, filtering for high probability setups only, and mastering emotional discipline to stick to your plan. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. In trading, profits may grab the spotlight, but it's risk management that keeps traders in the game. No matter how good your trading strategy is, without proper risk management, you're just one bad trade away from losing it all. Risk management isn't about avoiding losses, it's about controlling them so they never get big enough to wipe you out. Professional traders don't focus on how much they can make, they focus on how much they're willing to lose before they even enter a trade. Now that we understand why risk management is the foundation of successful trading, let's learn how to calculate exactly how much you should risk on each trade. Before placing any trade, the first question you should ask yourself is, how much am I willing to lose if I'm wrong? Professional traders don't risk their entire account on a single idea, they decide on a fixed percentage of their capital for each trade. A common guideline is risking 1% to 2% of your total account balance. This way, even if you lose several trades in a row, your capital remains intact, and you can keep trading. This approach turns trading from a gamble into a controlled business process. Position sizing answers the question, how many lots, units, or shares should I trade to keep my loss within my risk limit? In price action trading, your position size is determined by three factors: your account size, your chosen risk percentage, and the distance between your entry and your stop loss. For example, if your account is $10,000 and you risk 1% per trade, that's a maximum of $100 loss on any single trade. Whether the stop loss is 20 pips or 50 pips away, your position size will be adjusted to keep that loss capped at $100. With your position size set, the next step is stop loss placement, and in price action trading, it's all about putting it in the smartest spot. Stop loss is your safety net, it tells the market, this is where I'm wrong, and I'm out. But in price action trading, stop loss placement is based on market structure. Place your stop loss beyond key price levels, like swing highs, swing lows, or strong support and resistance zones, where your trade idea is proven invalid. For example, if you're buying an uptrend, your stop loss should be placed just below recent swing low. If the price breaks it, the market has shown your setup is no longer valid. This approach protects you from unnecessary stop-outs caused by small fluctuations, while keeping your losses limited and controlled. Every trade carries risk, but as traders, we want the potential reward to be worth that risk. That's where the risk-to-reward ratio comes in. It compares the distance between your entry and stop loss to the distance between your entry and take profit. For example, if you risk 50 pips to potentially make 100 pips, your ratio is 1 to 2, meaning you're aiming to make twice as much as you're risking. In price action trading, a good risk-to-reward ratio is often 1 to 2 or higher. This way, even if you win only half of your trades, you can still be profitable. The key is to measure your stop loss and target before entering the trade. If the RRR doesn't meet your minimum standard, skip the trade, no matter how good it looks. Remember, trading is not about winning every trade, but about making more when you win than you lose when you're wrong. Now that you understand the power of RRR, the next step is controlling your overall account drawdown so you can survive losing streaks and stay in the game. Every trader experiences losing streaks, but the real danger isn't a single loss, it's drawdown. Drawdown is the percentage your account drops from its peak to its lowest point during a losing period. The deeper the drawdown, the harder it becomes to recover. For example, if your account falls by 10%, you need about 11% profit to get back to break even. But if you lose 50%, you need 100% profit just to recover. That's why keeping drawdown small is critical. The best way to control drawdown is by managing risk per trade and setting a maximum daily or weekly loss limit. Many professional traders stop trading for the day if they lose 3% to 5% of their account, preventing emotional decisions that make losses spiral out of control. Remember, trading isn't about avoiding losses completely, it's about making sure losses never get big enough to threaten your survival. Your first goal as a trader is to stay in the game. Not every price action signal is worth taking. In fact, one of the most powerful forms of risk management is simply not trading low-quality setups. Trade filtering means you only risk your money when the odds are clearly in your favor, when the market is showing strong confluence between multiple signals. For example, instead of taking every pin bar you see, you might wait for one that appears at a key support or resistance level, aligns with the overall trend, and is confirmed by market structure. By passing on weak or unclear setups, you reduce unnecessary losses and increase the percentage of trades that work in your favor. Remember, professional traders make money by being selective, not by trading more often. Every trade you take should have a clear reason backed by your strategy, not just a hunch. In trading, your greatest enemy isn't the market, it's your own emotions. Emotional discipline is the ability to stick to your trading plan no matter what's happening on the screen. Without it, fear will make you close trades too early, greed will make you overtrade, and frustration will push you into revenge trading. In price action trading, discipline means trusting your analysis, respecting your stop losses, and following your rules even during losing streaks. One of the best ways to build discipline is by trading with risk you're comfortable losing. This removes the pressure of needing a trade to win. Keep in mind, professional traders don't just manage trades, they manage themselves. Staying calm and consistent allows you to execute your strategy without being hijacked by emotion. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.